Dividend growth investing. Picture it as the wise old owl of the investment forest perched high and mighty, watching the roller coaster of market trends whiz by with a knowing twinkle in its eye. It's been around since the days when stocks were traded under the shade of a tree and investors wore top hats. This method isn't just about picking stocks with dividends. It's like matchmaking for your portfolio, looking for those stocks that don't just pay a dinner date, dividend today, but promise a lifetime of increasing anniversaries, dividend growth. It's the slow and steady suitor in a world of flashy, fly-by-night dates. Welcome to Dividend and Conquer. Today, we're embarking on an exciting journey, diving deep into the captivating world of high-potential stocks. These financial gems are not just surviving the market's twists and turns, but are thriving impressively through their robust, growing dividend payments. Stay tuned. Let's kick things off with our first stock highlight. Broadcom, recognized by its ticker AVGO, is a shining star in the dividend growth stock arena. It's not just any stock. It's like the Hollywood celebrity of the stock market, always in the limelight for the right reasons. In the early part of 2023, Broadcom made waves, much like a surfer conquering a gigantic wave, with a substantial 14.1% increase in its dividend. This isn't just pocket change, we're talking about a raise to an impressive $5.25 per share quarterly. Now, why is this increase turning heads? It's not a one-hit wonder, but a part of Broadcom's consistent chart-topping performance in dividend growth, boasting a 5-year compound annual growth rate of over 21%. This kind of growth is akin to a snowball rolling down a hill, gathering size and momentum. It's impressive, steady, and frankly, a bit exhilarating. Broadcom's strategy isn't about flashy one-time payouts. It's about delivering a performance that gets better and better year after year, much like a seasoned artist perfecting their craft. But how does Broadcom sustain such growth? Well, imagine Broadcom as the clever chef in a high-end restaurant, but instead of whipping up gourmet dishes, it's cooking up semiconductors. The secret ingredient, its business model as a fabless semiconductor company. It's like throwing a potluck, but only bringing the dessert. Broadcom designs the tech while leaving the heavy lifting of manufacturing to big players like TSMC. This is like having your cake and eating it too, minimizing capital expenditures while still enjoying the feast. This strategy, combined with a knack for high-margin products, turns Broadcom into a veritable cash flow powerhouse, kind of like a magician who pulls not just a rabbit, but a whole cash register out of a hat. And let's not forget the cherry on top. Strategic acquisitions. The recent VMware deal is like adding a sprinkle of glitter to an already sparkling crown, further bolstering Broadcom's royalty status in the market. It's not just playing the game, it's setting the board. Remember, if you're finding this video informative and engaging, give this video a thumbs up and consider subscribing to Dividend and Conquer for more content like this. However, it's important to approach Broadcom with a balanced view, much like a tightrope walker maintaining their poise. Despite its solid growth prospects, akin to a rocket soaring upwards, the stock's current valuation suggests a slight tilt towards overvaluation. It's a bit like a gourmet cake that might be a tad too sweet, still delicious, but best enjoyed in moderation. This is particularly true in the context of the booming semiconductor AI industry, where excitement can sometimes inflate values like a balloon ready to touch the sky. Nonetheless, Broadcom remains a high-quality choice, a sort of blue chip in the tech world, for those eyeing long-term dividend growth. It's like a trusty old compass in the turbulent sea of the stock market, guiding investors towards potential treasure. Investing in Broadcom isn't just about catching a wave, it's about joining a voyage with a captain who knows the waters. Its consistent performance and strategic moves paint a picture of a company not just surviving, but thriving in the competitive tech landscape. Moving on to our second highlight, Deere & Company, or DE, is more than just an industrial icon. It's a growth juggernaut under the John Deere brand. Think of it as the Hercules of the heavy machinery world. Strong, dependable, and always ready to go the extra mile. The company's dividend history is particularly intriguing, characterized by sporadic yet significant increases. It's like watching a sleeper athlete suddenly sprint ahead in a marathon. Over the past 5 quarters, Deere has raised its dividend 4 times, with the most recent hike being a noteworthy 8.89%. It's not just a raise, it's a signal of robust health and confidence in the future. But what's the secret sauce behind these increases? Deere's dividend growth is closely tied to its earnings growth, akin to a well-oiled machine where every part works in harmony. The dividend payout ratio based on net income has gracefully fallen to 14%. This is like a skilled juggler who keeps adding more balls to the act without dropping any, a sign of sustainable and growing dividend prowess. However, a more cautious investor would also peek behind the curtain at the free cash flow payout ratio, which stands at a healthy 34%. This number tells us that Deere isn't just making empty promises, it's backing them up with solid financial discipline. It's a balancing act between rewarding shareholders and reinvesting in the business, and Deere seems to be dancing to this tune quite elegantly. In essence, Deere's approach to dividends is like planting a seed and nurturing it patiently. The sporadic increases aren't whimsical, they are calculated moves, much like a chess grandmaster planning several moves ahead. This strategy has allowed Deere to not just maintain, but grow its dividends in a way that is both sustainable and reflective of its underlying business strength. For the discerning investor, Deere presents an opportunity akin to finding a rare gem in the rough. It requires a keen eye to appreciate its true value. Despite these positives, I'm yet to add DE to my portfolio. A deeper dive into the factors driving Deere's rapid earnings growth since 2020 is needed to fully understand its future growth trajectory. If you're interested in a comprehensive review of Deere's stock, let me know in the comments below. Our third stock to watch, Aflac, known by its ticker AFL, is like the superhero of the insurance world. It's not just any company, it's a dividend aristocrat, strutting its stuff with over 25 years of consecutive annual dividend growth. Think of it as the insurance industry's version of a rock star on a never-ending world tour. The company recently struck a high note with a remarkable 19.05% dividend increase, which is music to the ears of investors. This isn't a one-hit wonder. It's a continuation of Aflac's greatest hits album of impressive growth trends. With a 10-year compound annual growth rate of over 10% in dividends, Aflac is hitting all the right notes, balancing between being a crowd pleaser and a savvy business. This is complemented by a payout ratio that doesn't just walk the sustainability talk, it runs a marathon with it. For dividend growth investors, Aflac isn't just an attractive option. It's like finding a golden ticket in the world of investments. It's the kind of stock that makes you want to put on your investor's hat and do a little happy dance. In conclusion, these three companies, Broadcom, Deere & Company, and Aflac, represent compelling opportunities for dividend growth investors in 2024. Their recent dividend increases are a testament to their strength and potential for sustained growth. Before we wrap up, I have a question for you. Which of these three stocks do you find most appealing for your investment portfolio, and why? Drop your thoughts in the comments below. Remember, we are not financial advisors, and the content presented in this video is for informational and educational purposes only. Always consult with a licensed financial professional before making any investment decisions. Thanks for watching. Don't forget to like this video and hit the subscribe button for more insightful investment strategies and stock market analysis. Check out our previous videos for more insights into building a stronger, more profitable portfolio. Stay tuned for more content from Dividend and Conquer.